Hello friends, welcome to my channel. Today we will discuss about two financial ratios, return on equity and return on capital employed, and try to find out which is the best measure of finding out operating efficiency of any company. So let's get started. So return on equity is calculated as net income divided by shareholders equity. So net income is comprises of what is earned by the company throughout an year minus all the costs and expenses in that same year. It includes payouts which are made to preferred stockholders but not dividends paid to common stockholders. So this ratio is also important because it shows how much of surplus does the company generate for its shareholders. Okay, it can either be allocated as dividends or it can be plugged back to the business in the form of retained earnings. So one recognized weakness of ROE, return on equity, is as a performance measure lies in the fact that the disproportionate level of company's debt results in a smaller base amount of equity, and hence it produces a higher ROE value for a very modest amount of net income. So it is best to view ROE value in relation to other financial efficiency measures. ROE is a efficiency measure. So a higher ROE ratio will mean that the company is using its investors' money more efficiently in order to enhance corporate performance and allowing it to grow and expand to generate increasing profits. That's what it means. Let's understand from an example the concept behind return on equity. So let's take two companies A and B, and these companies are operating in textile business. So these companies have made a profit of 20 lakhs for the financial year 2020-21. And but now how we are going to compare the which is the greater of these two in this scenario, because both have reported the same profit, right? So now just for an example purpose, we are assuming that the investments received by these two companies, A and B, for A it's 1 crore and company B has attracted investment of 2 crores, which is nothing but shareholders equity. So now to calculate the return on equity, the net income, which is the profit earned divided by the shareholders equity, so that would come around, for company A it would be zero point 0.2 and for company B it will be zero point 0.1, which is a ratio. So this puts the returns from the two companies in a new perspective now. Because both companies have reported the same profits, the management of company A is more efficient in converting the money invested into profits. Hence, it would be wise to invest in company A as management is more efficient in generating profits. When the return on equity has to be compared over a period for a company, it enables us to judge how the management has evolved in allocating the shareholders' equity appropriately. An increasing return on equity will mean that the management has been improving its efficiency of investing the shareholders' capital over the years in order to generate higher profits. Return on capital employed, or also called ROCE, is also another financial measure, and it also calculates the efficiency of the company. So, how it is calculated is it is basically earnings before interest and taxes (EBIT) divided by capital employed. So here the capital employed will include all the available capital to the company. It includes equity, which is shareholders' equity. It also includes debt, long-term debt, and other forms of debt. So everything together is what the capital has been employed to the company, and this ratio includes both of those all kinds of capital. So the ROCE is also a important metric for evaluation. Let's understand from an example of return on capital employed. So let's take a same example which you have taken for return on equity. It's the same case of two companies A and B which are in the textile business. They have both earned a profit of 20 lakhs and have investments, attracted investments. Company A has an attracted investment of 1 crore and company B has attracted investment of 2 crores. But in addition to this, the debt taken by the companies is different. So company A is having 3 crores in loans and company B is having 1 crore in loans. Now the ROCE will be calculated uh, as per the formula which I mentioned in the earlier slide. So you have to divide the profit, EBIT basically, not profit, EBIT, earning before interest and taxes, and then you need to divide it by the total capital which is available, which includes the debt also in addition to the shareholders equity. So the ROS computed for the company would come to around zero point zero 0.05, and company B it would be 0.067. So now if you look at these figures, it will tell you it will give you a perspective as to how these two companies have employed their capital which is available to them in order to earn the profits. So here if you see, company B is having a better ratio compared to the company A, so it shows that investment in company B would be more favorable. ROE considers profits generated on shareholders' equity, but ROCE is the primary measure of how efficiently a company utilizes all available capital to generate additional profits. So it can be more closely analyzed with return on equity by substituting net income for EBIT, which is earnings before interest and taxes, in the calculation of return on capital employed, ROCE. So this ROCE works very good, very really well when you compare the performance of companies in capital intensive sectors, which are like utilities, telecom, reality. All of these companies have higher debt levels, and so ROCE considers debt and other liabilities, whereas ROE only considers the shareholders equity. So hence, depending upon which area the company is into, you need to appropriately use the relevant metric, which will provide a better indication of financial performance for the companies which are having a significant debt. Let's try to interpret both of these ratios together: return on equity and return on capital employed. So when ROCE is greater than ROE, then what it means is that the company has made intelligent use of debt to reduce its overall cost of capital. But there is also a counter view to that. So when ROCE is greater than ROE, it can also mean that the debt holders are being rewarded better than the equity shareholders, which is not good for equity shareholders. Another thing to consider is the ROCE. If return on capital employed is higher than the cost of capital, it would make a favorable investment. But a case where cost of capital is higher than the return on the capital, it is a red flag. So here the existing shareholders would choose to exit, and potential investors would prefer to stay away. The legendary investor Warren Buffett is also having a point of view on return on equity and return on capital employed. So what he says is that both the return on equity and return on capital employed ROCE should be above 20%. The closer they are to each other, the better it is, and any large divergences between ROE and ROCE is not a good idea. I hope it is clear now as to how to best use these two financial metrics before evaluating the investments, or to evaluate two companies in operating in a sector. Do like, share, and subscribe the video so that in case I create any new video on any financial topic, you will get a notification. Thanks a lot for watching. Thank you.